Hello everyone, this is Matthew Fraley with BreakpointTrades.com. First off, I hope everyone is having a nice weekend so far. You're not getting overly depressed by all the crazy negative news out there. Anyway, this video that I've posted on YouTube, by the way, this is a private video for Breakpoint Trades members. It's not public. I'm simply using YouTube's bandwidth. Also, I'm recording this on my entire screen, so it's higher than a 1080p resolution. Please watch this on a large monitor if you can, and at very least watch it in a 1080p monitor if you can. Otherwise, it may look a little small or fuzzy. All right. So again, this is going to be a directed video on the systems, particularly the SPY systems. I'll also make some comments on the reversion to mean type system, or the trending system we have, the KISS system here. But it's going to be primarily on the SPY systems like you see here. All right. So if you happen to be new here, hopefully this gives you a little more info. If you've been here for a few years, you should understand this stuff a little bit more. Steve will be doing, of course, the detailed analysis on the market, and he'll be posting that here today. This video is not going to be about that. It's going to be on the systems. I'm going to try to keep it as brief as I can. Steve and I have a tendency to talk and talk. It's still probably going to be 20 minutes or so, just to give you a heads up. So anyway, if you haven't done so, go to the SPY systems section. There's SPY. There's the 401k KISS type system, which is an experimental reverse or an experimental trend following type system. I'll be discussing that briefly. There's some of these other systems here, reversion to mean, like McClellan, Bollinger Bands, and of course the collection of SPY systems. So click on this. If you haven't done so, please take the time to read over this section. It's pretty detailed. It gives trade examples. There's the list of trades here. There's an FAQ, detailed, discusses the systems. There is system statistics, which have also various sub tabs. I haven't updated these stats in about a year or so, but they really haven't changed appreciably. They're basically all still the same. So again, look over this area if you're new, if you haven't done so. All right. But basically, the SPY systems are a collection of 21 systems. Okay. So reversion to mean type systems, except for the breakout system, which is just like it sounds. It's buying breakout conditions. It's not a reversion to mean. All the other systems are reversion to mean. So we have a collection of 20 systems. So my thought here when I made all this was to develop as many individual systems as I could for a couple reasons. So number one, when I looked at systems out there, like there's a popular reversion to mean system called Larry Connor's RSI2 type system, and it's a pretty decent system on its own, but it's one system, right? If that's all you used, it could get out of sync with the market or the instrument. So part of my diversification risk model was to develop all these individual systems so that, if any one system got out of sync with the market, you have all these other systems that are doing their own individual things. And, the likelihood of all these systems getting out of sync with the market is, pretty astronomically low. And again, I have a brief description discussing what some of these systems do. You can see I have 12 systems that look for long trades, 9 systems that look for short trades. All right. These have been developed over many years, and I do have some ideas for some other systems, but time is always an issue with Steve and I. It seems like there's never enough time to work on this stuff very much outside of our normal, market newsletters and family life, stuff like that. But, reversion to means here, basically what they're doing is, they're looking to buy pullbacks and uptrends. They look to short rallies and downtrends. They also look for extreme cases in the market where maybe you're too far away from the 9 EMA. Maybe you've ran up too many days in a row. Maybe you've sold off too many days in a row. Think of these as statistical type trades. They look for their statistical odds, high probability type trades. They look for extreme examples in the past, that don't happen very often. Maybe the S&P down 9 or 10 days in a row. That's pretty extreme. So it looks for those past opportunities. that are high odds, say 90% or higher for some sort of bounce attempt, or, you know, for a short, a pullback, and it looks to take those trade opportunities. I drew up this, not this one, but let me pull it up here. I drew up a crude example here. Again, please, I didn't spend much time on this, but this is just kind of an example of what reversion to mean systems look for. So here's a general uptrend. You're uptrending, you get pullbacks, you're in a strong uptrend, you're getting shallow pullbacks, and then you get a little deeper pullback in that uptrend, but you're still overall uptrending. So reversion to mean long type systems will look to buy these shallow pullbacks. I have various reversion to mean systems that are dedicated to only buying these shallow pullbacks in a very strong uptrend. The shallow pullback systems don't look to buy the deeper pullbacks. They get deactivated. Okay, like so it's times like we're having now, they're not buying that. All right, then I have some pullback systems that'll buy a little deeper pullback, like you see here. You know, then they'll sell the first rally attempt, such as a wave B, a lower high. You know, they'll look to exit on a move back above a short-term moving average, like an 8 or 9 day moving average. You know, you get your you get stretched on this initial sell-off. You get your reversion to mean back here. All right. Then I have systems that'll look to buy deeper pullbacks and longer-term uptrends, maybe like down here, that will catch the wave C's, and will sell, or once in a while will end up catching a decent rally up in, you know, that's a longer move. The same for downtrends. The systems, I have systems that look to catch that'll short rallies and overall longer term downtrends. I also have systems that'll short once in a while in uptrending markets, but look for exhaustion conditions like this, where, you know, let's say you're up 20, let's say you're above the 8-day moving average for 25 days in a row, and you get an extreme over bought RSI 1% indicator. They'll look to do that. I also have systems that look to buy exhaustion conditions, where the market is sold off too far, too fast. I have two versions, one that does this in bull markets and then one that does it in bear markets. So there's one that's called the bull exhaustion. There's one that's called a bear exhaustion, which you typically only see, say, in deep bear markets like 2008, or, you know, you're way below the 200-day moving average. Obviously, a bear market long would not trigger in these market conditions. Here's my breakout system, which again is not reversion to mean. You're going up. You're already overbought, but it's buying that, and market typically goes up or continues to do this trend. The breakout systems use a hard stop, a traditional hard stop. The reversion to means do not, and I'll explain a little bit more of that in a minute. Here's an example of a system that also looks to take shorts. It's a 60 stochastic short. It's where the 60 stochastic indicators say trending above 80%. Pulls back above 80, then curls up under the 80% area, starts to curl, and it takes a short here. Those can obviously occur in uptrending markets too. So that's an example of kind of what the reversion to mean systems are looking for. Someone asked me, well, why didn't a bunch of short systems trigger on the current market? Well, because, you know, the market's been uptrending, and we only have had, this is essentially one decent correction in the downtrend. You know, we had one little oversold bounce, but, you know, in my extensive testing on reversion to mean systems, shorts were some of the most difficult to do. Because if you think about it, guys, long term, the market is uptrending, you know, 80%, 90% of the time. If you think about it, bear markets are short trends. You know, 2008 was a year long. And really the big decline in 2008 began in the late summer. So bear markets are short periods of times in the history of the market. So most of the time, market is uptrending or going sideways, and you want to look for general long opportunities. Your short trades are only in certain times in the market. And a lot of when I tested my short conditions for reversion to mean, you know, if I wasn't careful, they had a tendency to get caught in really strong rallies. And that can be just as painful as getting caught in a decline. All right. So anyway, getting a little long-winded here, but that gives you some general info. So let's kind of move back to the the systems. So going to the SPY system section here, if you go to the trades, we're currently in a first entry or 3 entries on the QE BTS system here. And you can see there's 2 tables here. Just for simplicity, I show a table for ETFs, and for options, I show $10,000 for each instrument. Again, you know, that's just an example based on a round number of 10. You do whatever fits your style. So you can see we have 3 open entries here on the QE BTS subsystem, SPY, SSO, and UPRO. And of course, we have the option trades here. All right. Now, first question I always get is, what about stops on these systems? All right. So the systems do have stops, and hard stops do come into play. But the initial trade, the only subsystem that has a hard stop on the initial entry is the breakout system. Going to the systems, here's my workspace on TradeStation. I have all the systems on, collect these 21 systems added to these 6 type of charts. So if we look at the systems individually, here's the subsystems for the SPY, the long subsystems. So the breakout system right here, as you see, is the only system that has its own, that has an initial hard stop that can come into place right here. All right. And the reason why is because it's already buying breakout conditions overbought. See, there's more risk to it, and it's a traditional type of trend type system. The reversion to mean type systems on their initial entry do not have hard traditional stops. What they do is, on a bad trade, they look to exit a rally, okay, or a bounce attempt, reversion to mean type that occurs in a downtrend. Remember, in markets, you know, even if you go back to 1929, they just don't go straight down. You get this stair-step effect. So if the reversion to mean systems get in a bad trade, they exit on a bounce instead of at the lows on a hard stop. I tested this every way from Sunday. You know, I've tested it many ways, and the results were always the same. If you used a hard stop, you almost 99.9% of the time, you stopped out near a low, and it was always better to exit after a bounce. You got better prices. So that's why I don't use hard traditional stops for the initial entries. It's better, I found, to exit on a rally. All right. So the current open trade we have on the QE BTS here, it doesn't have a hard stop. It'll look to exit on a rally attempt. All right. Now, what you can do on your end, you know, do what fits your style. If you need a hard stop for your psychology, go ahead and set one. All right. But otherwise, the system will exit after some sort of bounce attempt, whether that occurs right now or we go lower first. All right. Also, one question I get is, what is the current max drawdown on these systems? Well, it depends on the subsystems. So as you can see here, I have all these long systems. So here's the current system that's long, the QE BTS. So let's take a look at the max drawdown. So the easiest way to do that is, instead of looking at the 3 entries, I went ahead and copied over here, and we're just going to show 1 entry. So let's look at this at the statistics. So here's the statistics with 1 entry, profit factor of about 21, which is very decent, about 87.5% winning trades. Anyway, max drawdown here is about 8.4%. All right, because I have this set to, you know, $10,000, something like that. So this is your max drawdown. Historically was 8.4%. All right. Here's the historical trades. Now, what is our current drawdown on this trade based on the first entry? So currently our drawdown is it's less than 4%. So historically, while this sell-off is pretty, you know, doesn't feel too good, it's still less than half of this drawdown here where the system took a long trade on February 25th, 2020, and then it exited on February 5th, 2020. See that trade ended up being down 8.4% before you got some sort of rally attempt. And by the way, you could see that trade lost about 0.24%. So it exited on the bounce for a much better price than, simply setting a hard stop. One idea you could use, I don't use it, is, you could say, all right, well, the max historical drawdown on it is 8.4%. So I'm going to set a hard stop at, say, 9% or something like that. So where you set a hard stop just a little bit wider than the max historical. So that's an idea if you wanted a hard stop. Obviously realize that statistics can be broken and your stop could be hit at the new max historical stop and then, or drawdown, and then you get some sort of bounce attempt. You could also look at the average historical drawdown. But anyway, otherwise you can see, the average or the max loss closing trade was only about 2.4%. So again, shows the effect of, the systems exit better after an oversold bounce than they do at a hard stop at the low. So the whole point of this was to give you an idea, guys, of, some previous statistics, what about stops? So the systems, most of these exit after a bounce opportunity. So you can use that information to either set your own stop or just go ahead and follow the systems. All right. My other approach, again, I briefly discussed it in the opening comments, was, and how I also devise these systems to perhaps, say, trade in like a hedge fund would be, that's why I have all these individual systems. They're all their own systems. They all are made to trade on their own. They all have high stats, high statistics. So because of that, if I have a collection of money that I'm going to trade by the systems, I trade it collectively. I divide it into these individual systems. So, if one system here gets in a trade or a bad trade, I only give a portion of my money to any one subsystem. And so that allows me to trade other subsystems that may trigger and could make up for a potential bad trade on one subsystem. So that was my approach to diversification and risk management, was, make all these individual systems that are doing their own thing. And so, what? Big deal if one system has an early entry or a bad entry. One of these other systems will likely take an entry and make up for it. Now, as far as overlap, the most I've seen is 3 or 4 systems in a trade at one time. You could see none of the other long subsystems have taken a trade. And someone asked me, what if they all take a trade? That's impossible. So for example, the breakout trade, which you see here, that's obviously deactivated. There's not going to be any breakout trades here. The S-trap only looks for pullbacks and shallow uptrends. This system won't trigger. The trend system, the moving averages, say the 50, 200-day, need to have a positive slope. So this system isn't deactivated. That's not looking for a trade. Some other subsystems that could trigger would be, this system won't trigger here either. This is the QE Momo. That's also a shallow pullback type system. Kind of like this. It's only looking to buy these shallow pullbacks in a very strong uptrend. So it too is deactivated. So the only systems that could take a trigger are maybe like, let's see, the bull exhaustion. This would be if you got really extremely oversold in the short term. It's a very higher probability. The RSI oversold, but that's very, very far away from triggering. The bear exhaustion, probably not. That only occurs in deep bear markets. We're not in that territory yet. The bear long, probably not either. We need to be very strongly below the 200-day moving average in a bear market condition. No. CCI system, that could possibly trigger, though CCI is not at extreme levels. So those are some subsystems that could possibly take, an entry should we get another decent leg down. Market is quite oversold here, as Steve will state. So I do think we could have a little bit more down move, but the odds do favor some sort of bounce this week, unless we had some sort of crash like a Black Monday, which I hope we don't get. Here's the various systems that look for shorts. So again, nothing there. Why were there no recent shorts here? Well, we really just began downtrending since here. So, the systems now will maybe start looking to short rallies, especially if this gets deep enough. Okay. I do have some ideas that could perhaps be low risk trade opportunities, short that would give us potential shorts with the cycle indicator, or say at times when say price. So here's some of the KISS charts. Here's the Qs. Notice how the Qs below their ATR here, and maybe times when you're going sideways and price gets really close to the ATR there, has a reversal. To me, that's a low risk short opportunity. So I may look at adding a particular short trade based on that, but just haven't had time to do it. So again, guys, that gives you an idea of the SPY systems. We currently have one open trade here on one of the 12 long subsystems. Remember, that's part of the risk management. For me, trading these systems, I don't put all my money into one subsystem. I have it divvied up to allow for, multiple long subsystems to trigger in case I needed it. All right. There's no hard stop on this initial trade. Currently, it's down about 4% from the entry, and the max historical drawdown is about 9% or about 8.5%. So that gives you some context. It's still nowhere near historical drawdown. It's only about halfway. And the system's reversion to mean look to exit on a bounce opportunity instead of a hard sell-off. Do what fits your style. And here's the same set of subsystems on the ES futures component. They obviously give a lot of similar trades, but different trades. But you can see ES is currently also in the same trade. 3 entries on the QEBTS. All right. A couple other things I do want to point out. I do think 2022, and I think most of you agree with me, 2022 is going to be one hell of a volatile year. These reversion to mean systems tend to do best on years of volatility, high chop up and down. So here's some statistics. I'm not done with them. I will post them when I finish them. I have the trades. I've compiled them for SPY and ES. All right. And, for example, 2017 which was the least volatile year in 95 years, 100 years, had the least trades because there was hardly any pullback corrections. And in fact, most of the trades were the breakout trades. But periods of high volatility, 2018, a lot of trades. Okay. 2019, an okay amount of trades. So 2016, a decent amount of trades. So these systems excel in volatility. And that's why I think we're going to have quite a few trades here in 2022. All right. Remember, the systems, these aren't trend following. They simply look to get in, look for a trade opportunity based on statistics. They get in, they get out, they look for the next trade opportunity. They're kind of like a tiger who's waiting in the weeds for his prey. They see that prey, they pounce, and then they simply go back to waiting for a trade opportunity. They don't just simply run out at any prey that's walking around. They wait for the best opportunity. All right. Last thing I will discuss a little bit is just my trend following type systems, which, the KISS systems, which are completely mutually exclusive to the reversion to mean. It's a completely different type of thing. Trend following systems, by the way, are much more difficult, in my opinion, than reversion to mean. Reversion to mean are based on statistics. You can backtest, look for statistical high probabilities based on extremes. You're looking to get in, get out. Trend following is difficult because you got to, say on this uptrend, you have to have it not stop out on these little pullbacks. Do you want it to stop out here and then buy back here? You don't want it to buy here on this initial A move down, or do you make it wide enough to, stay in this whole thing? Trend following, again, they have to try to ignore noise. They have to try not to get caught It's very, very difficult. You know, I've been developing systems for many, many years, and the trend following is much more difficult. That's why, you know, this is all still a work in progress. Here's a look at one of my my KISS workspace, and I have two versions of, say, this KISS trend for the daily S&P and, you know, other instruments. This here is the wider version. This here is the, you know, triggers a lot more, you know, it's a little more on noise. It gets out better, but, you know, there's also areas where it exits quite a bit more. This is the version here, and you can see just how this looks. You know, it's designed to stay on a lot of these trends, try not to stop out on some of this noise, and you know, it has to deal with these areas of consolidation like this. And here's obviously a bit choppy, you know, would have stopped out here. So otherwise it does a pretty good job, but you know, something like this is extremely difficult, and you know, I still have quite a few things that ideas that I'm working on with this. But people always ask me, well, where is this? Why isn't this complete? It's much more difficult than you realize, you know. Here's some other things that I've been working on with a little bit too. So I'm going to use this this allows all these bars to show up on all the charts. So down here, it's one of my overbought indicators. So whenever it spikes above these bands, kind of gives you early warnings, maybe to, say, if one was long, to reduce longs. You can see it occurs right up here for a correction. Back here, you can see it gets above the bands. Is that November 5th? Albeit it's a little bit early, but you know, you do get a correction here and eventually get a bigger correction. Back here, gets above the bands right there. You can see that end up being a pullback. So, you know, that's something that I may look to point out as areas if someone is long, they could reduce or add some, say, hedging. See right here, spikes out, and then you do get a quick correction. All right. Overall, you could see what this looks like. Anyway, guys, that's enough. You know, the video is mainly supposed to be over the reversion to mean, which I did. This is something I'll go over another time. Like I said, it's still a work in progress. All this stuff really is a work in progress. And anyway, that'll do it. We will see what happens this week. It's obviously everyone's anticipating the market futures open, probably one of the most anticipated. Got a FOMC this week, so it's going to be an interesting week. Anyway, have a good rest of your Sunday. Take care.